If you were watching the markets, you would have seen something analysts swore was absolutely impossible. The very bedrock of the North American economy just cracked wide open. The source material for this explainer is describing a brand new reality, one where the United States and Canada are now locked in what it calls a total, unrestricted financial war. $113 billion. Just look at that number. That is the staggering figure at the very heart of this crisis. According to our source material, this is the value of American banking assets that are now, for all intents and purposes, frozen solid, held in a regulatory chokehold by their closest ally. In a move the White House apparently never saw coming, Canada just suspended the operating licenses of major U.S. banks. Now, to put that in plain English, the source is claiming that Canada basically kicked Wall Street out of the country. And just like that, a simple trade dispute became a full-blown financial shockwave. This, of course, raises a massive question. How on earth did we get here? How did a fight over steel and lumber escalate into a financial blockade? All right, let's break down the chain of events laid out in the source material. Okay, let's really dive into this. The story we're looking at isn't about some simple policy disagreement. No, it's being framed as a historic failure of American leadership, one that completely blindsided Washington and sent Wall Street into a state of absolute, unmitigated panic.
To really get the blockade, you have to understand the battle that came first. This wasn't a sudden storm. It was more like a pressure system that had been building for over a year, driven by what the source calls the Trump administration's use of the economy as a blunt instrument.
The narrative lays out a super clear timeline of how things got so bad. It kicked off with those 25% universal tariffs. Then came threats against Canadian energy. The pressure kept mounting with demands that would have, effectively surrendered Canadian economic sovereignty. The thinking in Washington was, hey, Canada will just fold. But instead, so here's the crucial point. The source argues the entire U.S. strategy was built on a totally flawed assumption, that Canada needed the U.S. way more than the U.S. needed Canada. It was a massive underestimation of their opponent's strategy and their will to fight back. So, while Washington was busy focusing on 19th century trade goods like steel and lumber, Canada was apparently gearing up for a 21st century counterattack. They decided to turn their unique financial structure into a weapon. Now this really gets to the core of how Canada was able to pull this off. The U.S. system is described as, fragmented and chaotic. But Canada, their system is a unified block of 6 financial fortresses, which gives the government an incredible amount of centralized power to wield. And this right here brilliantly illustrates just how methodical this whole thing was. The source describes it as a surgical strike. First, they identified the weak spot. U.S. banks relied on Canada to service their massive corporate clients. Then, they invoked national security to issue an emergency directive, suspended their licenses, and ultimately, as the source puts it, they welded shut the pipeline of money flowing back to Wall Street. Boom. This move wasn't a warning shot. It was a direct hit. The source details the immediate fallout, describing pure chaos on trading floors and a logistical nightmare for huge corporations, all while Washington was apparently caught completely flat-footed. The market reaction was reportedly instantaneous and absolutely brutal. We're talking billions in market cap for banks like JP Chase, just wiped out in minutes. For the very first time, Wall Street investors realized they were not immune to the consequences of a trade war. And it went way beyond the stock market. The narrative describes a huge crisis unfolding inside major U.S. corporations. With their American banking channels totally severed, companies like Ford and Walmart were suddenly unable to fund their own Canadian operations. This created a logistical nightmare that was allegedly engineered to inflict maximum targeted pain. So as the White House scrambled for a response, demanding retaliation, they reportedly slammed headfirst into a terrifying reality. Any move to seize Canadian banking assets in the U.S. would be, in a single word, suicide. This is what the source calls the financial dead man's switch. And the argument is pretty simple. Canada's big 6 banks are so deeply woven into the American economy, holding real estate, municipal bonds, you name it, that attacking them would blow up American retirement accounts and freeze credit for American businesses. The trap was set. Retaliating would actually hurt the U.S. more than it hurt Canada. So, how does a big fight between politicians and bankers actually affect your daily life? Well, according to the source, when banks take a multi-billion-dollar hit, they don't just, absorb that loss. They pass it on to you. The source material predicts a direct and pretty immediate impact. Banks are going to tighten lending, which means higher mortgage rates and a much harder time getting a car loan or a small business loan. It also forecasts inflationary pressure from a disrupted supply chain, driving up the cost of everything from lumber to electronics, all while your 401k balance starts to shrink. So this brings us to what might be the most dangerous phase of this whole conflict. The source lays out 3 possible scenarios for how this crisis could unfold, maybe in the next 48 hours. First up is the scenario the source believes Canada is really banking on: market surrender. The idea here is that the pain on Wall Street gets so intense that bank CEOs basically march into the Oval Office and force the president to drop the tariffs, sign a humiliating agreement, and save the economy. Then there's scenario B, which the source calls ego escalation. In this version, the president refuses to admit defeat, doubles down, and retaliates against Canadian banks. This, the source warns, would trigger a global financial crisis that would make the 2008 crash look like a warm-up act. And finally, there's the wild card: legislative intervention. In this scenario, Congress, completely terrified of an economic collapse, moves to strip the president of his tariff authority. This would create a massive constitutional crisis, but it might just pull the economy back from the brink. Whatever happens next, the narrative concludes that the illusion of American economic invincibility has been totally shattered. A middle power, acting with incredible precision, literally brought a superpower to a dead stop. And the story leaves us with a final, very pointed question about leadership in a world where the old rules, well, they just don't seem to apply anymore.